keep up with the demand. And we're not feeling that just yet, but we will at some point in time. Is that going to be 3 years, 5 years? I'm not sure, but we will feel that at some point in time. So it's a great way to diversify. I feel good about where we're headed and what that number is going to look like as far as the price of oil. So let's talk about what makes up oil. We use it obviously for, gas in our cars, which actually makes up about 42% of what the current oil that's produced. 42% of that is going into fuel for vehicles. But it also is used to make concrete and pretty much just about everything, plastic, the things in your office, cosmetics, sports balls. It's in just about every product you can possibly think of. It makes up everything. So it's more than just fuel for your car. It's also, diesel and jet fuel, and things like that as well. And I like to bring this up because I always get electric vehicles are going to eliminate the need for oil. And um, that's a whole nother conversation, but it doesn't eliminate the need for oil. In fact, and the amount of energy that's being supplied through renewable resources such as solar and wind power, I think you'd be really surprised to hear how much those things actually need oil as well, even just to even be made and continue to function. So let's see here. This is one of my favorite graphs. This talks about how much energy is used throughout the world, and I won't go deep into this, but you can see over here to the right, natural gas, oil, and coal is providing a vast majority of the energy that's being used, and the amount of energy being provided by renewables is, I think it's about 10 terawatts, or less than 10% of this 180,000 that's being used. And like I said, if anybody ever wants to do a deep dive into this conversation, I'm happy to do it, but it's a pretty insignificant amount compared to the amount of energy that's needed. So let's get into the tax benefits, because this is a conversation that I have with just about everybody. A lot of my investors are high income, high net worth. They've got, capital gains coming. And one of the great things about investing in a working interest, and that's one of the things I want to point out, there's a lot of different ways to invest in oil and gas, royalties. There's different things, but the working interest is what you have to invest in to get the tax benefits. So most oil and gas deals, and I'm not going to say all of them, will be able to pass along anywhere from an 80 to a 90% of your investment depreciation in that first year, in that year that you invest. And a lot of that is coming from the intangible drilling costs, which are fuel, labor, a lot of what it takes to drill those wells. And so our last deal that we closed November of 2023, we ended up passing along 82.66% depreciation, and it can offset any kind of income, W-2 income, income from anything else actively that you're involved in. It can offset passive income and capital gains. So for active income, there is a cap on what you can offset in 1 year, and it's $250,000. For capital gains, there is no limit. If you've got a $10 million capital gains problem, I can fix that just as much as I can fix a $10,000, capital gains problem. The other great thing is that all of the income that is produced from these wells, every single year you get what's called a depletion allowance, which is a 15% discount. So you're only paying taxes on 85% of the income year after year. So those tax benefits are great. And the other thing I'd like to point out about that depreciation you get in year one, let's say we pass along 85% in year one, you will still get that other 15% in coming years. So you end up ultimately getting 100% of that investment, but you're only going to get that first part in the first year. So hopefully that makes sense. Now, one of the things I like to also take a look at is really breaking down this tax deduction example. I'm a visual person, I learn better through this. So let's say you have a $500,000 a year income, you're in the 37% tax bracket. If you do a $100,000 investment and we are able to pass along 85% depreciation in year one, that means it's going to reduce your taxable income by $85,000. So now instead of being taxed at $500,000, you're going to get taxed on $415,000. So that is how it impacts it. A lot of people thinks it will reduce the amount that they're having to pay in, and that's just not accurate. So Now going, at 500,000, you had $185,000 tax liability, made the investment, knock 85,000 off, and now your tax liability is 153. So it's essentially saved you, $31,000 as far as taxes that's being paid. And one of the things that I like to do is provide K1s. These are sample K1s from previous years, and if anybody ever needs to take that information to their accountants, they can say, look, if I do this kind of investment, kind of here's what the write-offs look like, and we can pass that along so you can see how it's going to apply directly to your specific situation, and is it going to help you or not? Because I believe, as much as I want to have everybody with me for everything, we need to make sure that it makes sense for what you're trying to accomplish in your financial goals. So the risks. Let's talk about the risks, because oil and gas, as much as I love it, it is there's a lot of different risks, and I find that there's a lot of opportunities out there. There's a lot going on. So the returns are not certain. This is not like an apartment building where I've got 300 doors. I know what my vacancy rate is. This is what we're charging for rent. And this is what we're going to, increase those rental rates. We have a lot of different things and varying factors that affect what those returns are. So obviously the price of oil is a big one. If you have a working interest, the price of oil matters. And one of the things that we do is we provide a calculator that shows, you can go in and change what your return is at $50 oil, at $70 oil, $100 oil. So you can see what those variances are and what those returns look like at different commodity prices. And I always recommend everybody do that in any project that they're potentially looking at. One of the other things is if your wells aren't drilled, there's no assurance you run the risk of drilling a dry well. So you run the risk of not even hitting oil. Once you've hit that oil, the next biggest concern is, okay, what are they going to produce? Because during that drilling process, you're able to determine if the wells are going to be commercially producible or not. So these big companies, they'll go in, and even the smaller companies go in, they drill these wells and they go, okay, you know what, there's not enough oil in the ground for us to bring these online. So they're able to figure that out before they even start producing, which is great. So, and I'll get into a little bit about, surrounding production and things like that. So as far as the, oil and gas, are you going to hit it? Are you going to drill a dry well? Is there going to be enough oil in that for commercial production? And then you go through delays in drilling. And I know I'm giving everybody the warm and fuzzies, right? Like everybody's really excited about all of this now. You can have delays in drilling, drill bits break, you've got to trip pipe when that happens, which means they're pulling all that pipe back out of these, 2 and 3 mile holes, so they can switch out drill bits. And that's a really dangerous process. So, and then the other thing that I like to point out, because depending on who you're investing with and where you're coming at in the project, if you're in a working interest, that means you have monthly operating expenses. So you're going to get a bill every month for keeping those wells going. And if the price of oil drops down below whatever the break-even amount is for an extended period of time, you could end up having to write a check to cover those expenses if you're not making enough money on the price of oil. So that is, and I don't want to scare everybody on that. I've owned my own working interest for about 12 years now. I've got interest in about 70 wells. I've had that happen one time, and it wasn't even in 2020. It was back in 2016. So it really just depends on that situation. And even on that, the check that I had to write was about $1,500. And I didn't want to have to write it because it was $1,500 when, we weren't making any money that month. However, the amount of money I've made on those wells over this last 12 years, significantly outweighs, that one check that I had to write. But it's something I want people to understand and know that there is the risk of that. So talking about all of that, our strategy, and I can tell you anytime I've ever lost money, it has been with smaller companies, and I'm not knocking the smaller companies. However, what we do is we go in and acquire a working interest with major oil and gas companies. Like our current deal is with EOG Resources. They're a multi-billion-dollar company, and they are either about to drill the wells or they have just drilled them. in a proven area. We are only going with major oil and gas companies in a proven area that we know is producing, and that's really about it. It's pretty simple. So typically they start paying out in that 90 to 180 day time period, and then we just sit back and enjoy, the cash flow. So, and I'll get a little bit further into that. Our last deal was with Anschutz Operating in November. Our current one is with EOG. So um, obviously, just like real estate, location and operator matter. And the operator really matters because just like EOG and Exxon and these bigger companies, they don't need our money to move forward. They don't need our money to begin with. And that is the biggest question I get asked is, EOG being this huge company, why do they need your $5 million? And they don't. And like this deal I currently have, they only owned 87% of it. Somebody else, when those mineral rights came up for sale, somebody else was able to acquire that 13% interest, and they were willing to sell it to us. And so we bought it from them, which is great. So EOG, they didn't need us to partner with them, but they don't have a choice because we were able to acquire that interest outside of them, if that makes any sense. And we can dig into that a little bit further. But, we provide information on the operator, any of the pipeline hookups. Obviously, if you're in a proven area, a lot of those pipelines and things that are needed are already into place. This area that we're currently drilling in Wyoming is the #1 producing area in Wyoming. And EOG was actually the first one to start drilling there back in 2009. So we'll take a look at different pay zones, life expectancy, production potential, and what the completion costs might be and things like that, the timeline. So we give all of that. Now, let's talk about due diligence. And this is something, I'm not sure if my screen do y'all see a document on the right or is it blank?
It's blank.
On the right, yeah, it's blank. And part of the left is written out, right, as it should be.
Yeah, so I'm not sure why that is not showing up. Let me see if I go back, and I am literally out in the middle of nowhere, right outside of A&M, and our internet has not been fantastic. I know. So, well, okay.
Is this slide in the deck that you sent to me? Maybe I could pull it up and
yeah.
Oh yeah,
is.
I've got it here.
Okay, so I can, and maybe if I just stop sharing and let me do a refresh. I apologize, guys. I'm usually not struggling with these. Do you want to share yours?
Yeah, let me share right here. All right.
Perfect.
Can you see my screen?
Okay.
Yes.
Perfect. Yep. And I'll let you flip through them and that will be perfect. So,
Sounds
okay.
Good.
When you acquire mineral interests and these working interests, they get recorded at the county level just like real estate does. And so this assignment on the left, this was our deal in November. I put this on here because it has this recorded information. We're still waiting for some of these final documents to come back from the current one. I have the recording, but we're waiting on this final, booking number and things like that. But you can actually see that we acquired and I don't even have my little readers down here. I've just hit the age where I have to have readers, but you can see all 12 of these wells that we acquired with Anschutz, and it was roughly about a 3% interest. They go in and they get recorded. We have those API numbers, and depending on what state it is, every single state has a governmental agency that shows all of the information for all these different wells. So these were in Wyoming. So in Wyoming, it's the Wyoming Oil and Gas Conservation Commission. So I can take these well names or these API numbers and plug them in and specifically pull up each one of these wells. And I can find out who the operator is. I can pull all of the permits, so I can find out when they were permitted to drill. This spud date right here is the date that they started drilling. I can get the completion dates. I can find out when they're planning to frack. And then I can go in and go, okay, I can get the production, and I can get that production by day, by month. I can get Anschütz's entire production for the area. You'd be blown away at the amount of information you can pull. You can find out, the latitude and longitude, how deep it was drilled. All of this information is public information. So one of the things that I do is provide a spreadsheet to my investors that has a link from each one of these wells directly into Wyoming's, deal. But I provide all this information so they can go pull it themselves, along with the county recording, so that you can show that we do actually own this interest. And here is all of the information, so you can verify that what I am sharing with you is accurate. And so I find that there's a lot of transparency missing in a lot of the oil and gas stuff. And maybe it's not that it's missing. I think a lot of people don't know what to ask for and what to look for. So this is really important for Texas. It's the Texas Railroad Commission. I've never drilled in Oklahoma. I think it's the Oklahoma, it starts with the something commission. It's an OCC. And so anyway, there's one of these for every single state. And so this is a really important tool to be able to use to verify all of the information that I'm passing along, or any other oil and gas company for that matter. All of this is verifiable through third-party governmental agencies, which is really, really important. So Daniel, if you'll flip to the next slide.
Yep. And whenever you would like to circle back on some of those topics that you said we'd explore more, I'd be happy to pose some questions around them, because I want to make sure that it's all well understood.
Same. So our current offering, we just acquired we're passing along an 11.44% interest. It's 4 wells in Campbell County, Wyoming. It's the Niobrara, which is the top producing area in Wyoming. We are partnering with EOG, and I guess partnering is really the wrong word, because they didn't ask to work with us. We bought that interest, and so we own that much, that 11.44%. Every single bit of oil that comes out of the ground will come over. That 11.44% of the production comes to us. These wells, the great thing about this is the wells were drilled. They have been finished, and they go down about 10,000 feet vertically, and they go out about 2 miles horizontally. So they are finished, and they are due to be fracked at the end of this month, very beginning of July, which means we will be online and producing in July. In that drilling process, they are able to determine that these are commercially producible, viable wells. So they will be fracking them and bringing them online. Now, the caveat to that is I don't know how much oil is in there. We do know that these are commercially viable wells. I do have information that shows the production from all of the wells in the surrounding area and what we are expecting them to do. We do expect each of these wells to produce about 800,000 barrels, which is about 3.2 million barrels total for this estimation. And I've seen these talk about, that they'll pay out for 20 years. I would say in that first 10-year time period is where you're going to get the majority of your return. And really 80% of it's going to be in that first 5 years. And these deplete very quickly. This Niobrara area, you're going to get a really significant amount of your payout in that first year once they come online. And then it depletes really quickly between that first and second year, a little more into the third, and then it really starts slowing down. So it's a pretty steep decline initially, and then it levels off and goes down the rest of that. And I've got a pretty good calculator built out on what those payments are going to look like, all estimates based off of the production right in that immediate area. So we don't have a ton of it left. There's a little bit of this left. I opened it up about 2.5 weeks ago. Daniel and I had some really great conversations, and this is the calculator that I will pass along to you. I have this set at $80 oil. Some of the things that I want to point out, and it's set at $80, we have stayed in that $75 to $80 price range over the month of May. It's really important to go, okay, what does it look like at 50? And I have a slide on here on what that looks like, the returns at $50 oil, 70, and you can go in and change the investment amount and that price. Now, we will be producing gas from this too, but it's not very significant. These are primarily oil and gas wells. And one of the things I'd like to point out is our net revenue income on a $100,000 investment at $80 oil is about 300. We're going to call it 304,000. We expect that you will have your return of capital in a 16-month time period. If you throw in the tax benefits, which will reduce your amount you're paying right around that $30,000, we estimate it'll be about 11 months. This $6,100 a month in income will probably be a little bit higher first and go down. It's kind of an average. So I just want you to understand that you're not going to get a $6,155 a month payment. Our November deal that we just closed, we just started our first payment. We had it May 1st, and on a $100,000 investment, that distribution was about $25,000. It was roughly about a fourth of that initial investment, and that represented about a fourth of that initial. It was 4 months of production because the wells came online in November, and then I believe, and I was trying to pull up the current numbers on what that other distribution was now. I believe this next one was about $4,000, and it will be $4,000 this month, and then it might be $6,000 next month. They fluctuate a little bit. They'll go up and down as they get things stabilized. And then, like I said, they deplete pretty quickly at first in this specific area. So Daniel, if you'll flip to the next, and I do provide that calculator.
Courtney, I hate to interrupt.
Yeah.
Like, for me, your audio cut off when you first named the first payout, which was the most exciting part of your presentation.
Yes. Okay.
Yeah.
Yeah. That first payment was It was $25,200 on a $100,000 investment, and so we had really great production, and it was November, December, January, and February's production. So it was 4 months of production, and we just had that first payment last month, which was exciting.
Nice. Then after 4 months, is the well dry at that point?
No. It's going to produce probably the most it's going to produce in that first year. They estimate these are going to produce for 20 years. I think really a 10-year time frame is a lot more realistic. That between 10 and 20 years is probably, when you get out 15 years from now, you're looking at $100 a month, payment or something like that. It's very, very small. Now, I will cash checks all day long as they are coming to me and it's not costing me anything. But the biggest portion of this, $303,000, that I would say 80% of that you're going to get in that first 5-year time frame.
Okay.
With the biggest part of that most likely in that first year once it comes online.
Keep putting the questions into the chat, everybody. I know I'm kind of holding on to a lot of them here for the end. So Courtney, just keep in mind, we've got a lot of questions.
Yeah.
And I want to
see we've got like 20 minutes. So
yeah, after this next slide, I'd like to kind of back up and understand what are the different points along an oil production normal pipeline or the construction of an oil well? How do you invest at different points of it? And what point is this actually investing in? How is this different in its risks and its returns than other points along the way? And then also, how did you guys acquire the oil rights to 11% of these wells when there's a big player involved?
Yep, those are really great questions. So this essentially is numbers that I took from the calculator. I plugged in $50 oil, $60 oil, $80 oil, $100 oil. And that way people could see, okay, this is kind of what we're looking at. If we're sitting at $50 oil, it's going to take about 22 months to get your return of your initial investment back. If it's at $60, it's going to take 20. So I wanted to put this in at different numbers so people could see what those returns look like at these different oil prices. I think it's really important because even though I feel good about what the price of oil is going to do, I don't have any control over what that is. And I like to be really realistic on what our issues are. Like this deal specifically, I cannot promise what's in the ground. I know we've hit oil. I know we've got commercially producible oil, but it might turn around and spit out, 500,000 barrels right off the get-go. And then one of those wells might not produce as well anymore. And, we could have one that stops producing. We need about 800 I'm sorry, we need about 1 million barrels of oil to return that initial capital, to return your initial investment. And I do have another really good chart coming up here in just a minute that I think y'all will appreciate seeing. So this right here, okay, you can see these stars, those gold stars right there are, oh, I didn't put the other chart in here. I think it was because we were going to run out of time, but, and I can actually bring it up if you want me to. Okay, so these are our 4 wells right here. So from right here to right here is probably about a 3-mile distance. That first little, blue dot to the left, you can see that, 3-mile arrow at the bottom. And all those blue wells, those are wells that have been drilled. And almost every single well in this area, guide, they're all horizontal wells that have to be fracked. But you can take a look and see that, okay, this one right here next to it, it was drilled in 2020. It's produced about 415,000 barrels. This one was, drilled in April of 2019. It's produced right about 400,000 barrels. You can see what these returns are. And these numbers are actually higher than when we built this out a couple of months ago, because those numbers continue to keep growing. Here's one over here that's produced, 1.1 million barrels since 2015. So our estimates are over this we're hoping in that 10-year time period, we're going to produce 800,000 barrels. And we take a look at what all this production looks like, built it in and applied it to our scenario and our situation. These little diamonds are wells, they're permits. They haven't been drilled yet, they're permits. So like I said, our estimations are based off of what is happening in the immediate area. And I'm just going to take a look. And I have all of these numbers built out into how much each of these wells produced in year 1, year 2, all the way through year 5, if they're that old. And I took it out a little bit further for the ones that were older, because this is actual real information on real wells right by where we are in the same reservoir, and those numbers matter. So we're looking at, I think the rough estimate for all of these wells in year 1 was about 250,000 barrels. We've got 4 wells, and that's about what we need to return capital in that year 1 once those wells come online. So it was really online. Now, a lot of these, and this is average. Obviously it could be, one of the wells could do a whole lot better. One of them could do a whole lot worse. So it was average numbers of all of them, all 14 of these wells combined. And you can go ahead and move on to the next deal. And I'd love to just start taking some questions. Because sometimes I have a tendency of forgetting what's might be common knowledge to me is not common to everybody else, and that'll give us a really good 15-minute section of time to go through. So if you think you might be interested and want to place a soft commit, you can scan mine on the left. I added Daniel's AIC club form on the right, and I'll let him talk a little bit more about that. But I'd love to kind of get into the nitty gritty, answer some questions, and go from there.
I tend to be somewhat of an academician when it comes to understanding exactly what's going on here. And since a lot of this group, originally started in real estate, and I think this group has got a pretty good understanding of how a lot of different real estate operations happen. Oil is fairly new. And so knowing exactly what the risks are, the benefits are, I like to know the background a little bit more. So I want to ask, this is a purchase of mineral and drilling rights. What is the exact thing that is being purchased here? Is it mineral rights?
We are purchasing a working interest. It's a wellbore interest. We're not even buying rights to like 2,000 acres or anything like that. It is very specifically that 11.44% interest into each one of those wells directly. That is it. That is what we bought.
And so you've got 11.44% interest in 4 wells here. How did you guys know that these wells were producing? How is it that you didn't buy interest in some other well that isn't producing? How did you target this specific area, I guess, rather than shotgun approach?
Yeah, and these are not producing yet. So they have not been brought online. They're drilled. But a completed well means that it has been fracked and it's being brought online. These are not completed, they're drilled. So this is such a good question. Now, there are landmen out there that are very much like real estate agents. And these, real estate agents, if they know that you are an investor and you're looking for properties, on the beach in, Los Angeles or whatever, when those properties come up that have a good potential to be a great rental property or a fix and flip, that realtor will bring it to you. They have those pocket listings, and this is very similar. So this land that we drilled on is federally owned, and at some point in time, the government came up and put these mineral rights up for sale, and people went in and bought them. And in this specific situation, EOG was able to acquire 87% of those interests that somebody else bought. And I'm going to call it 13 because it is a 13% interest, and we could get into why it's 13 versus 11.44. So we bought this 13% interest, and the people that own it, when they bought it, the landmen, they acquired it for about $250 an acre, but they sold it to us at $7,500 an acre. So they hold on to it in hopes that eventually somebody's going to drill, because if they do, the value goes up significantly. So once that happens, they come to us because they know the people like us, we're looking for interest with major oil and gas companies in major proven areas. So they come to us and say, hey, we've got this 13% interest over here. We've got a 3% interest with these 12 wells over here, whatever that looks like. So they know what we're looking for. They bring it to us, and they don't hold on to it, because this 13% interest that we just bought equates to about a $5.5 million check that we are now going to have to cut to EOG for the drilling costs of our percent. So we do own the 13% of everything that's being produced, but that also means that we are on the hook for 13% of all the expenses that those wells incur as well. So the majority, out of the $7.5 million, it cost us a little under $1.3 million to acquire that lease. And we've got about a $5.5 million check that we're going to have to turn around and cut to EOG for the drilling expenses for those wells. This is really great. A lot of times you don't get to come into a project where the wells have already drilled. Usually people have a plan and they're like, hey, we're going to raise $50 million and we're going to go out and buy, this, 2,000 acre mineral areas, and we're going to drill, 10 wells sprinkled over here. So this is a little bit different in that we are acquiring interest directly into these wells where they are either about to drill or they already have. And so I like this because I know EOG is good at what they do. I know Anschutz is good at what they do. If they're going to go put a hole in the ground, there's never a guarantee of what they're going to hit. But in this situation, we know that we've hit oil in all four. We know we hit commercially producible oil in all four. So now it's just a matter of what are they ultimately going to extract and what's the price of oil going to do. So we've eliminated a lot of that risk just based on where we're coming at into this project. And I like doing this because some of that exploration and wildcatting, I don't want to put investors' money there. You could hit some really great big stuff. For me, I feel like this is a really safe way to invest in oil and gas, just because we have bypassed the drilling process. We've bypassed a lot of the potential delays and things like that because of where we're coming at into it, if that makes sense.
Okay, so I wanted to ask you a question about the landmen that you mentioned here before. So they went out. So I see this kind of as a, they're land speculators or they're oil speculators. They're going out and they're buying the rights at a very cheap price. You mentioned $250 an acre. And are they going out and just buying large amounts all across, 10% here, 10% there, 10% all over the place?
Yep.
And
whenever things will come up for sale. Yep. Whenever
Okay.
things come up for sale, people just go out and they buy up everything that they possibly can. And EOG, I promise you, they would rather have 100% of this deal. They would rather not have this 13% owned by us, but somebody else bought it.
So the land people probably got access to those mineral rights at the same time that EOG could pay for them, right? Why?
Correct.
How was
Correct.
it that they got ahead or were able to purchase it before EOG got 100%?
It just depends on if they were brought out into different sections and things like that. Like it just depends on how it was presented and how it was sold. And I have never bought them on that end. My partner Rick with DW Energy, that is a really good Rick question. I'm not on that end of it, but he can. If anybody really has interest in that, we can really deep dive into that with him for sure.
So they use a shotgun approach. They buy up, 10% here of 10% of the rights on a particular acre, 10% on another, and they're hoping that a big company comes in and basically does all the work, and they're responsible for their 10% of the expenses, and the larger company is responsible for 90, and you own those rights, even though the larger company kind of sees you as an annoyance, to be honest.
Yeah, they would rather own all of their whole deal. But we acquired that interest, and because we own it, they have to cut us, 10% of everything they do. They don't have a choice.
Gotcha. Okay. All right, let's go to some of the questions that we have here, because we've got quite a few. And starting right off on the top from John Doe. What do you do to feel good about investing in things that have economic tax income benefits, but bring negative impacts to the environment?
Oh, that's a really, really good question. And, I don't know all of EOG's environmental things that they have in place. I know a lot of these companies are trying to reduce their carbon footprint. There's a lot of, carbon capture and things like that that are being put into place to help the environment. Unfortunately, this is one of those things that we need. I think at the end of the day, everybody's trying to do better. We need it for everything. Every one of those windmills that are out there producing energy in a renewable way uses about 500,000 barrels of oil. So there's a lot of and unfortunately, it's something that we need. Hopefully, we are, got these companies, and I really believe that a lot of them are trying to do things to do better, to support the environment. But at the end of the day, we need all of these things for just about everything. We need it for medical equipment. We need it for medicine. We need it for everything that we have. Every single piece of plastic, like I said, cosmetics, sports balls, everything that we use in our daily lives comes from an oil and gas product. It's used, oil and gas is used for it. So I don't have all of the environmental answers as far as that goes. And I've had people that it doesn't align with them, and it doesn't align with your environmental things, and it's probably not the right investment for you. And that's okay too.
I'll throw my 2 cents in here. One thing I've realized in investing and just, business and life in general is that a lot of things are due to perspective. And if I were to say that, over the last 100 years, the economic environment that we have built up has caused climate-related deaths to plummet by 98% versus 100 years ago, because we have better infrastructure, we have better materials, we have better medical interventions, all of these things which oil has helped produce in our modern economy. I can say, yes, there are negative environmental impacts, but the impact on human society is actually quite good. And so it depends on your perspective. And those perspectives matter when you're investing, because you want to invest in things that you feel good about and you feel is a net benefit to people. Anyway.
Agreed.
Next question here. How do you see the cost of fracking reducing per barrel as a competitor to Permian-based drilling?
Okay, wait, say that again?
Yeah. How do you see the cost of fracking?
Hey, Daniel, you can skip it because she already mentioned she's fracking everything, so it doesn't matter.
Oh, okay.
Okay.
All right. So next, do you foresee any of these tax benefits going away, since governments are trying to incentivize more environmentally friendly energy sources like solar and electric cars? This is from Ramesh.
No, that's a great question. And I will tell you, I can tell you that we are already not producing what we need to produce, and we have not been exploring and drilling and getting the permits we need to keep up with demand as is. And so, and I don't know where you have these. Are these under like Q&A questions? That way, when I start thinking about stuff, sometimes I get distracted and I forget what.
They're just in the chat window. I tend to go through and mark anything that has a question mark on it with the question mark icon. So is that what you're looking for?
Yeah, and I'm
happy to read them off to you.
Yeah, if you'll just read that one more time.
So basically, do you think tax benefits are going to go away since governments are trying to incentivize energy-friendly sources?
Yep, and that would be a no. These were instilled. I mean, I think even back before the 70s. And they were put in place to get people to go out and drill and explore and do things because we really, really needed it. And so, and I was actually on a call with Mike Pine the other day, who is a CPA. He specializes in tax strategies and things like that. And he had a team go through and look and see if he could even find any tax returns that had been audited directly because of taking advantage of oil, the investments in oil. And they couldn't even find any over the last 30-year period. So I don't see these going away. They are there to incentivize exploration and drilling, which we absolutely need. In America, we use almost 21 million barrels of oil per day, and we're only generating, we're the biggest producers in the world at about 13 million barrels per day. And there's a lot of really misleading information. I read an article recently that talked about how much we're exporting because we export a lot of what we're drilling, and we actually import more of what we use because it is cheaper for us to import what we use than it is to refine what we're drilling. And so, but there's still a 8 million barrel deficit from what we need to what we're producing. So I don't see that going away. And I don't see it going away anytime soon.
We've got 1 minute left. And so I'm going to say, first of all, I know this is a new topic, and it's a newer topic for me as well. So if you're interested in learning more on this topic, Courtney and I are actually going to produce a mini educational course. Our plan is to get together and put together 8 to 10 videos that are 20 minutes each, kind of walking through the entire industry, what it looks like to invest, where the risks are. So we're going to put together a mini course, and that'll be available soon. If you're interested in that, I meant to actually modify the AIC Club form to say have a question there if you're interested in that. If you're interested in that, there is a question at the bottom of that form that says, do you have any other comments? Just put there that you're interested in the course, and we'll be making that, and it'll be coming out in the next few weeks. Also, since Courtney is a club fund sponsor, her QR code is on the left. You've seen the club form on the right. The club form on the right is more just a pre-step gathering information. So it's are you interested? Would you be interested in investing as a general partner or as a limited partner? And I know we didn't really talk about what the difference there is in terms of an oil and gas partnership, but basically it's whether the tax benefits can be passed through as active income or passive income. And so go ahead and check out both of those. You're always welcome to invest directly with the operator, or you can go through the club and come in at a lower minimum. Let me see here. There are a couple of questions about the exit, and I know you've mentioned this a couple of times. Unlike a real estate investment, and I know we're at the top of the hour now, unlike a real estate investment, once the oil well is completely run to the point where it's not producing anymore, what is the exit strategy at that point?
Yeah, there is not an exit strategy. These will continue to produce until they are not economically feasible to keep going. So as long as we are making money on them, we will keep them online. But if we get to the point where it's okay, we've depleted these suckers, we're going to plug them and take them offline. And the same thing where I talked about that monthly, if the numbers go down and we're sitting at $20 oil and it's actually costing money, EOG will go in and turn them off during that time period and wait for the price of oil to go back up. They are not, whereas, we've got that 13%, they have 87, which means it's costing them significantly more money. So they are very incentivized to keep the costs as low as possible. So if we have something happen, and let's say we're flooded with billions of barrels of oil all of a sudden, and we've got this mass surplus, they will turn those wells off in the meantime until the prices of oil goes back up. So we're not going to sit here and incur, cost after cost, month after month. And then, like I said, if we get to a point where, we've pretty much, produced all of these wells that they can produce, they'll assess it and be like, okay, can we re-stimulate it here? What can we do with it? And then they'll make that happen, and they'll either plug them and it'll be done, or they'll re-stimulate them and keep going. So they will just keep going until everybody, as long as everybody's making money. The second we're not making money from it anymore, they'll turn them off or plug them up. I hope that makes sense.
That does make sense. And we're at the top of the hour, and there are a ton of good questions here. So I think what I'm going to do is I'm going to gather them all up and send them to you, Courtney. And
yeah, and maybe we'll do another
I can
quick,
email out a
recording or
questionnaire.
something. Yeah, let's, gather that up. And then, and if anybody, I think if you go to CourtneyMoeller.com, or even if you want to fill out the soft commit, you can put 0. And I think even when you fill that out and I can send the information over, there will be there will be a place where you can schedule a call, or I don't know, Daniel, we can figure out what is going to be the best way to do this.
Yeah, just schedule a call. What is your minimum investment?
Mine is 100. Our minimum is 100. Depending on the situation, I do have some people that come in at 50. I'm always happy to, obviously my liquidity changes, month after month, and depending on, what I've got divesting and what's happening. So I understand everybody's situation is different.
All right. And there's a couple of people asking about the fund. The fund should be, the Alternative Investing Club fund should be ready in about 2 weeks. And our minimum is 25,000. And I'm going to present to the group a way to invest as a general partner, in which case you'll get the tax benefits as active income or as a limited
Yeah,
partner.
and we, just so that y'all know, our break-even cost on these wells is $37. So if we're above 37, we're doing great. If we get below 37 for an extended period of time, that's when we could potentially be, having costs. And I'd like to talk about that a little bit more too, because we do have a little bit of a contingency in place to cover that should it happen. Obviously not indefinitely, but that's a really good question. And
Courtney,
yeah.
we're actually, I want to stay on schedule
I know,
here.
I'm sorry.
So I'm going to ask everybody
I'll stop
here.
talking.
No, it's not. I'm going to ask everybody here. That was a great talk. Everybody here, take yourself off mute and thank Courtney for coming in and speaking to us today.
Thanks, Courtney.
Thanks,
Thank you,
Courtney.
Courtney.
Appreciate it.
Thank you.
Thank you, Courtney.
Bye.
Thank you.
Have a great day.
Thank you.
And like I said, I will take all the questions. I'll send them to you, Courtney, and then I'll send them out in an email to the whole club to make sure that people get their questions answered.
Yep. And you know what? I'll do a video recording and we'll ask them and answer them and shoot it back out. I think I like that better than typing it out.
All right. Thank you so much.
Thanks. Bye, guys. Have a great weekend.